All right.
Thank you. Welcome, everyone. I'm glad to be here, share some perspectives on what's happening. It's a really uncertain, kind of unprecedented time right now, for sure, with markets. And I think we're all quarantined at home right now. So as we go, I want to make this presentation as applicable to what's happening in everyone's lives. So please feel free and invited to submit questions to the chat. And Jake, if you ever want to interrupt me as questions come in, I'm happy
Yeah, I'll
to.
watch the chat. So please put your questions in and I'll jump in and make sure Sam can answer them.
Yeah. So my the framework that I was going to follow today is kind of address some of the main questions that we're getting from many of our private clients that we work with. Try to make this as applicable to each of you as possible. Starting with what is happening with markets right now. Obviously, we have the coronavirus happening that's infecting the world, and we have an accelerating rate of infection in the U.S. and globally in most countries. But how is this affecting markets and our investments and our portfolios? So I'm going to share my screen here. And let's come here and look at some charts. So this hopefully can lend some perspective as to what's happened so far this year. So this is showing market indexes around the world with stocks. The US is that purple one. And you see here that the US has dropped 24% from the beginning of the year, which is interesting because you've probably heard larger numbers than that if you're listening to CNBC or the radio. This is from the beginning of the year. So there was a fair amount of gains at the beginning of the year and then a big drop. Okay, so first of all, note that performance is all relative, but we're still in one of the larger downturns of modern market history. From this high water mark here to what is that, middle of February, the bottom was down about 37% from there, for both U.S. markets and world markets. And of course, we had gains of about 9% yesterday, and then gains today as well. So what does it mean to be living in such a down market? What the market's really interpreting is a loss of profits and economic activity that that's happening because of the coronavirus. At first, interestingly, the fear was that there would be a big supply side shock, that because factories were closing in China and across the world, that it would disrupt supply chains and you wouldn't be able to get goods and services from overseas into our Walmarts and into other retail outlets and things. But as it became clear that the US was going to be infected by the coronavirus, it changed to be more of a demand side shock, to where we're all locked in our homes, and there's a limit. It was limited nationwide of people going in to buy things. The travel obviously has been impacted, probably most of all, but across a large number of industries, the demand has really decreased quite a bit, which has caused this large decrease in asset value across the world and in markets. Now, one thing that's important to note is that markets are very forward-looking, and economic activity is now. And so I think many of us are feeling, when is this bottom going to come? The bottom's going to come when markets see a light at the end of the tunnel, I think is the best way to think about it. Economic activity will likely continue to decline for several months into the future, and maybe even longer than that. But markets will start to turn once they see that light at the end of the tunnel, which we've kind of seen the last 2 days. The light at the end of the tunnel is represents that federal stimulus package that will hopefully be passed later this afternoon if things go well. And so markets are pricing in future profitability as well. And the stimulus is conveying to markets that there's a path to profitability because of the almost $2 trillion that's earmarked for the stimulus package. And so we're in this big downturn, but markets are hopefully looking to move upward from here. They've seemed to so far. It doesn't mean they can't go lower in the future. Just because we've had 2 large upswing days so far doesn't mean that they can't go lower. So I wouldn't base any decisions off of trying to time that the bottom was just 2 days ago, because it could continue to go down if rates of infection don't continue to accelerate and things. But what does this mean for us as investors long term? What does it mean for retirement accounts and other investments? One thing to remember is that markets come back, and that downturns are always temporary. I've had a number of people asking, what if the bottom just falls out? What if I lose all my money? If you're in a diversified portfolio, which hopefully most of us are, there's never a risk of your money going to zero or even long-term kind of losing value. So this chart shows the cycles of expansions and downturns in bear market and bull market terms. So according to those definitions, you can see there's been a number of bear markets since 1926 when this data starts. But if you compare the blue to red, obviously the bull market times when the market's going up are a lot longer than the times the market's going down. And look, the bear markets, the very longest bear market ever happened here in 1931 at 34 months. And that was part of the Great Depression. And as bad as things seem now, the Great Depression was much, much worse. And financial markets and world economies were much less developed at that point. I don't think we're anywhere near a situation like that. If you look back to 2008, which was really the worst year in market history, that still only lasted about 16 months of a bear market. In fact, the bear market of the dot-com crash in 2000 to 2003 was only 25 months. So whatever pain you're feeling now, please remember that it's temporary. The market will come back, and that should affect our investment decisions. One thing that's really important to remember is if you hold a diversified portfolio, especially a diversified global portfolio, this implies that you're invested in the entire world economic order, okay? So for example, our portfolios that we create for clients, for our private clients, hold about 13,000 stocks across the globe. So 13,000 different companies, that's the majority of the tradable world market. What that means is as long as you can go to Walmart and you can buy a wide variety of goods or some other store, your portfolio is going to hold majority of its value. Because think about if you're going to a store like Walmart and think about just one of those little trinkets you could buy, or even the food or anything else. The supply chains required to create the raw goods, transport them to somewhere else to be manufactured, and transport them to Walmart. How many different companies and services and goods are involved in that process? It's enormous. Those supply chains stretch across the globe, and each of those companies has to be making a profit. And when we own a diversified portfolio, we're owning pieces of all those companies. So as long as goods and services are flowing across nations and across borders, and you can see that by going into a store and seeing a wide variety of things, then your portfolio will hold value and will in the long term increase. And so even though it's pretty frightening when you hear, oh, the stock market, the Dow Jones dropped 3,000 points today, or S&P 500 dropped 7% today, it's scary. Long term, it shouldn't have as much of a material effect on our long-term investment outcomes as it might feel in the moment. Let's look at this chart that I think is really instructive. It's showing the growth of the US stock market after different financial crises. So we have the stock market crash in '87. That's the flash crash, biggest single day drop in the market ever. The US savings loan crisis in '89. LTCM, if anyone remembers that, in 1998, that bailout, that was in the middle of a big bull market, so we didn't even see any downturns from that. The dot-com crash in 2000 was obviously very significant, the 9/11, and then 2008. And what I'd like to point out is this light blue bar that represents after 5 years. Even in worst case scenario, after 5 years after the dot-com crash in 2000, you're still up 10% from there. So 5 years from now, we're going to look back and be in a decent place. I think the chances are highly likely, and history would support that. And the very theory and understanding of how markets work supports that as well. So this is going to be a temporary thing. Now, how long? We don't really know. You can see in 2000, that was a really prolonged stock market downturn. It was still down 3 years later. I don't expect it to be that long. We went down so fast, it's possible we come up really fast as well. And we're in the green maybe towards the end of the year. I wouldn't base any of your investment decisions off of predicting outcomes like that. But maybe temper expectations to say, hey, it might take a year or two to get back to where we were, but in the long run, I'm going to be in a good place as long as I don't panic. And I think
Hey, Sam, real quick, a question popped up. I just think it's a good time to have you just kind of address it. It came in from Molly. I've elected to have a more aggressive mix of stocks and bonds than normally recommended for my age, and time to requirement, hopefully 7 years. It has paid off in the last 8 years or so. Should I switch to a little more conservative mix until things calm down?
That's a great question. And I'm glad you asked. I think there's some core principles here that are involved that can guide us in what gives us the highest probability of a long-term successful outcome. And one of those very core principles is to consistently buy low and sell high. Okay. And getting more conservative in a time of crisis like this is really the opposite of that. It's selling low. And so it's very tempting to get more conservative, and it's one of the most common questions that we get. But this is the worst time we could ever get more conservative. So really the strategy that would, in a typical case that we recommend in that situation, is to wait until things recover. And once things are more normal, valuations are back up, and that's when to get more conservative. And if you're feeling that way now, it's probably a sign that down the road, it probably makes sense to get more conservative, and there's maybe a more appropriate asset allocation for you potentially in that case. But now is the wrong time to get more conservative. And that's where people make big mistakes is they're feeling all this pain from the stock market coming down so far, and they want to get more conservative. And I'd say I'd caution against that strongly, unless you have imminent cash flow needs. But 7 years is a long enough time horizon. We're going to be hitting new market highs sometime before the next 7 years. And that'll be a more appropriate time to get more conservative. So I'd say don't get more conservative. In fact, what I'd say is stick with your more aggressive allocation through rebalancing. And we're going to get more into that. Part of the rationale for that is what's shown on this chart. Is what this is showing is returns after different levels of market decline. Okay, so the yellow is 1 year, the blue is 3 year, and the green is 5 year returns after a market decline. And this 9.61 number here on the right is the annualized return for all days. So the average annualized return is 9.61% for the US stock market. Okay. But I'll point out here the return historically after a 20% market decline, which we hit almost 40% as of 2 days ago, and we've come up quite a bit since then. So we're definitely in this camp, is well above the long-term average. So moving forward, history would suggest that returns will be higher moving forward. So I'm not saying that the market won't go lower in the short term, but at some point there will be a recovery, and our return moving forward will almost surely be higher on average than what we've seen the last few years. And so now is the wrong time to get conservative, because we tend to have higher returns moving forward. And once that recovery is realized, that's when we would want to get more conservative. Okay. And actually, let me just touch on this real fast, pointing to time horizon. And you mentioned a 7 year time horizon. How often do we have negative returns over different periods? So 1 year on top, 5 year in the middle, 15 year on bottom. You'll notice there's never been a 15 year period where stocks haven't returned a positive return. Okay. Over 5 years, it's small, and most of those are in the Great Depression and some in the 2000s, because the 2000s were a pretty rough decade. But 1 year, it's pretty random. So with a 7 year return, I think if you're a 7 year time horizon, you're in a pretty good situation to kind of wait it out, let the market come back into kind of all-time high territory before getting more conservative. And let's just shift to this as well. I think this is a really important point. And you'll see the title of this is Capital Markets have Rewarded Long-Term Investors. It's a great temptation in times like now to want to be very conservative, especially in bonds and cash. So this is showing the growth of $1 over the last 92 years or so. You notice that these bonds, while quite stable over this time period, barely outpace inflation over the long term. While equities up here, look at the difference in valuation, return quite a bit more, orders of magnitude more than bonds, which is why over long time horizons, we want to be more in equities than bonds. You'll notice the volatility in stocks. You have the Great Depression, you have the 60s and 70s, you have the 2000 crash and the 2008 crash. So all these things have happened, and yet we still create this tremendous amount of value by holding equities in our portfolios. And so it's important in times like this to keep this long-term perspective in mind, because all of us are going to be invested in the market in some capacity for the rest of our lives. So our time horizon is not just retirement, it's through retirement as well, till we die. And so we need this growth capacity that equities give us. And then the bonds are useful to create stability and a place to draw income out of. But please consider carefully before getting too conservative, because it's that stock side of things that really allow us to build wealth and outpace inflation long term. It's important, and even in retirement, to have an equity allocation that's sufficient to allow your portfolio to outpace inflation, or else you're at risk of a few years like 1945 through 49 or the early 80s, where you have 10% inflation for 5 years. You got $1,000 a month is now worth $500 a month. And so please remember that risk is part of investing, and we just have to learn how to manage that both behaviorally and in a portfolio perspective, to where we can really meet our goals and enjoy the ride to some degree. So what should we do from an investment strategy now? I'll come back to this. I think is another important question that we get from a lot of clients. I have some cash, or I have a portfolio. What do I need to do right now in order to take advantage of what's happening? And it comes back to this buy low, sell high principle. The easiest way to do that is to rebalance. So if you, let's say you picked a 60-40 portfolio, it's likely you're now closer to a 50-50 after everything that's happened. An easy way to buy low and sell high is to rebalance and get that back to a 60-40. And so you're basically selling 10 percentage points of the bonds to buy 10 percentage points of the stock. And that process of rebalancing forces you to buy low and sell high. Then once it recovers, we have the recovery, the stock market's coming back, then you're selling high at that point, and you're selling stock to buy bonds to stay at that 60-40 portfolio. And that process actually is pretty miraculous. It's a very simple process, but in the long run, you actually can have a situation where the whole is greater than the sum of the parts. And you've had a greater return on the individual pieces of your portfolio than those pieces actually returned over the course of that time period. It's a really, they say diversification is the only free lunch in investing, because it allows you to rebalance across assets that move differently. And now is the perfect time to rebalance. On the private client side, we've been getting I've been asked by by both clients and just personal friends, hey, what should I go out and buy right now? And many people are saying, hey, should I go buy Delta or Marriott or different of these stocks that are more depressed right now? What I would suggest in that situation is to buy a diversified mix of investments. So a portfolio, an index fund or global fund where you're owning thousands of different companies. The reason for that is there a good chance that Marriott or Delta, they come back strong and end up getting good return? Yes, absolutely. But is there a chance that they become the next GE? And GE is obviously a shell of its former self at this point. There's also the risk of that. And so if we hit for too many home runs with individual investments, at some point we'll get strikeouts. And long-term, the data suggests that it doesn't actually net add value always swinging for home runs, that a diversified approach with rebalancing actually has a higher probability of getting a good outcome than kind of hitting for home runs. So I'd suggest keep with a long-term philosophy. Now is a great time to buy if you have excess cash, but do it in a diversified way, in a long-term approach kind of fashion.
Hey, Sam, can you touch on maybe people that want to do that or change their allocation? What would you suggest kind of the best way to do that? Go all in on one day, spread it out? Like, how do you manage that as far as, if you put it in today and tomorrow drops 10%, how do you manage that risk and help someone?
That's a great question. All else equal mathematically, on average, the market goes up. The average day in the marketplace goes up. And so mathematically, you're best off putting it in all in one day as early as possible. But we don't live on the average individually. We're ourselves. And so usually the best outcomes for clients we found is by trying to spread it out. Now, in recent times, the markets have been so volatile that that sometimes spreading investments to buy in over days or just a couple of weeks has been sufficient spreading out because to capture some of that volatility. So what I'd suggest is if you're putting in a sum that feels like a significant sum to you, I'd spread it out over maybe a few weeks. And typically we would spread it out over a few months, but with things moving so fast that we've kind of shrank that down into weeks. In terms of changing allocations, which you mentioned, Jake, which I'm glad you did, we get a number of questions where people ask, is now a time to get more aggressive? Should I change from, we settled on the 60-40 before, should I switch to 70-30 until markets get better? I like the mentality behind that question, the buy low and sell high mentality. But I would suggest that if you're already in a portfolio that's most appropriate for you long-term, that it's probably worth staying in that and just using rebalancing to buy low and sell high. Because what that requires, it requires you to get timing right twice. And the data suggests, again, that timing the market in such a way doesn't long-term add value. So we're kind of opening ourselves up to some randomness. Not only do we need to shift to get more aggressive at a right time now, which is probably a decent time, but then we need to shift back to a 60-40 in that situation at the right time later. And on average, that doesn't tend to add value, that timing game. And so I'd suggest staying with your long-term allocation, but sticking with rebalancing to buy low and sell high.
And also to add to that, just because I know a lot of you on the call are in 401k plans, that kind of already happens where you're spread out over time. Every couple of weeks, money goes in. So in a way, you're kind of lowering your cost of what you purchased in your 401k automatically because you're just putting more money in. So a good way to take advantage of this market downturn is to change your contribution amounts that you're putting in, which there's no fee to do that. It's just you can increase it or reduce it any time. But if you can afford, and I know a lot of people are in different hardships, this would be a good time. You'll probably get a little bit better price on some of the things you're investing in and will grow over time. But other strategies go in play when you're talking about money that's already been taxed and you're putting it into the market in like an E-Trade or a TD Ameritrade account or something. So your 401k is a different monster to kind of think through because it goes through payroll. So just on my 401k addition to that question.
Yeah, that's a great point. And when you're contributing to your 401k, while the market's going down, those contributions disproportionately buy stock. So you're automatically buying low, selling high, just the way your 401k works. And the reason that 401ks are designed that way is institutionally it's understood this is the way to do things. And as an investor, personal investor, it makes sense to invest like the institutions do, not like the average individual does, because the institutions, they're considered the smart money. So we can be smart money ourselves by doing that. I wanted to share one more chart as well. That I think is really helpful for understanding the dynamics of buying when the market is down. Okay, so what this is showing is 2008. I think our situation now is fairly analogous to 2008. kind of with some 9/11 mixed in, where there's kind of a big one impact that affects the world. But in magnitude, it's similar to a 2008. So the three scenarios here are staying invested the whole way. Then the dark blue is exiting the market to cash and reinvesting after 1 year once you start to get more comfortable. And the green is to the exit market and then stay in cash the whole way. And I've met people that have done all three of these. I have met people that are still in cash from 2008 that were so traumatized they couldn't get back in. So who knows where we are on this first part. You might be here. Let's hope we're here. But we might be right here before there was a few false bottoms in 2008. We might even be here. Let's hope not, but it's possible. And people worry a lot about buying in, but what if it continues to go down? And I don't ever want to suggest that it can't go down farther, because it potentially could. But the principle is, we would much rather, let me change my tool here. We would much rather even buy here than here, right? Our rate of growth is a lot higher from there. Even here is a lot better than buying a month ago, right? My point is, I want to suggest that it's not important, and it's not even likely that we'll catch the bottom if we're trying to time our purchases to buy low. It's really hard to get that timing right. And so what's more important is that we are in a buying mode as things go down, which is accomplished through contributing to your 401k, through rebalancing our portfolios, through not selling low. And those outcomes are much, much better, even if we don't get the bottom perfectly, than missing the bottom altogether and waiting until we're comfortable. I think an important thing to remember is the bottom of the 2008 crisis was at March 9th of 2009. And if you go back and look at any magazine articles or newspaper or TV at that time, it was pretty doom and gloom. There was no public feeling that we were at the bottom of that crisis. It was really an existential crisis in 2008. We forget how bad that was sometimes. But there was no sign in any of the media that would suggest we were at the bottom, and yet we were. And it was a long time till public sentiment was recovered enough for people to really feel comfortable getting back in, kind of this timing that you see in that blue line. But that's really detrimental if we don't get that timing right. And there's no sign in advance that we're getting to the bottom. And so kind of to wrap everything up, I'd suggest that we're going to be okay. As long as we don't panic, sell the cash and lock it and turn paper losses into permanent losses. As long as we don't panic, we're all going to be okay. The market will come back. It always does. As long as you can go to Walmart and buy things, your portfolio will hold value. And so the important thing is not to panic, to buy low if you can. Keep a good amount of cash reserves to weather anything that might happen with each of our jobs, because unemployment's going to spike for sure. But the market's going to turn around when it sees that light at the end of the tunnel. It might have already happened. It's very possible that we haven't hit that bottom yet. But regardless of the short-term timing, in the long run, our portfolios are going to be okay, and this doesn't need to interrupt our plans for retirement or other long-term goals that we're reaching towards. So if there's any other questions, I'm happy to answer those. I know we're running short on time.
Yeah, there wasn't any questions in the chat that I saw, but if anyone else has any more, put them in the chat, or you can unmute your line. We definitely want to help you get through this and not be panicked. Know that this is a long-term play. You know, the 401k is something that you're going to use later on, and these drops in the market, I know they're scary. And so we want to make sure you know how to make changes. If you have questions about how to do that, I know a lot of the platforms that we're using, Voya, Vanguard, 401go, there's a few of them out there that we've used for our plans, and they have a different process when you're going to change your allocation or your contribution rate. So if you have questions or concerns about how to do that, because you usually have to change what you currently have invested and then what new money is going into, and there's a way to kind of combine the two. So that, if you have problems with that or it's difficult to do online, let me know. It's sometimes a little bit not as intuitive as I would like it to be, but I can help you through that. We did have another question come in. Will you please touch again on how to rebalance within the current allocation? Yeah, so I'll take that as far as in your 401k, and maybe Sam, you can chirp in as far as determining which allocation, what that means. When we talk about allocation, we're really referring to the percentage of stock to bond. So when we say a 70-30 or a 60-40, what we mean is that 60% stock and 40% bond. So the first number is the stock, the equity piece, same one, the same thing. We've talked about that in other webinars. And then the bond piece is the second number. So when you talk about increasing your risk or your aggressive portfolio, it means higher number on the stock side. So when we offer in all of our 401ks, we typically have 3 levels of investing. This is a quick review for everybody. If you've done nothing and you've left your money to go into your 401k and you haven't decided what investment to choose, we take your date of birth and put you into a fund that is tied to the age of 65. So if you're younger, it's going to be a higher equity piece. So that number will be higher, and it will automatically over time shift down to lower equity and higher bond as you get closer to 65. Level 2.
And those funds automatically rebalance on their own. I think it's
right.
You don't
yeah,
need to
so those auto rebalance, you don't have to do totally hands off. Level 2 is where you've picked an allocation and it stays at that. So let's say it's a 60-40. All right, it's not going to change. You'll get rebalanced each quarter, but it's going to stay there no matter what age you are. So you can still be, what I think people get hung up on is the age directs what that should be. And I'm not a huge fan. I don't know, Sam, what you think, but the taking your age and subtracting, and that's what your bonds, I don't even know what the formula is because I don't agree. There's a lot of factors that go into what your allocation should be. And your age is just one thing. You can still be 90 years old and be really aggressive and have no bonds.
Yeah.
But there's be reasons behind that other than your age.
It needs to
Same
be
as being young. But yeah, Sam, I don't know, what are your thoughts on the allocation discussion?
Well,
like,
ultimately,
how do you determine that?
It needs to be a function of your time horizon, your risk tolerance, your other financial moving parts. So, I mean, it's a big, long discussion with our private clients when we land on an allocation. I think on average, you're looking at, as a retiree is going to be between 60-40 and 40-60, and someone who's working is going to be between 80-20 and 60-40. But there's plenty of exceptions to that, and so it's worth thinking through. And feel free to reach out to us if you want any tips or insights or kind of reviews for a proper allocation for you. The easiest way is just retirement date. If you're going to, those target date funds kind of automatically decrease your risk as you get towards retirement. But if you're in a non-standard situation, there's plenty of reasons that you wouldn't want that specific glide path for your allocation.
Yeah, so a lot of it is determine retirement date and when you're going to spend the money. So the one thing you don't know is when you're going to die. So that's the toughest part, is how long is this money going to have to last in retirement? So just because you hit 65 and you're done working doesn't mean you're going to take your 401k all the way out, have a taxable event and spend it all. Retirement could be 20, 30 years. So the last thing we want you to do is to make that mistake and have a really high tax year because you took your whole 401k out. So as you start to transition into that whole, now this is not money I'm saving, I'm spending it, that's where you need to have a discussion and sit down with us, and we can help you kind of formulate a plan from a tax standpoint so that you don't kind of shoot yourself in the foot by creating a really, really expensive year in the tax side of things. But once you kind of determine those things and know where you want to be, and if it needs to be a change, let's say you're in a 60-40 and you want to go more aggressive now the market's dropped, you would need to log into your 401k and go to the investment section. And what I'll do is I'll put a couple of videos where I can screen record, and I'll put those on our website of how to do those things, because there's a few steps, and one is about rebalancing and one is about changing your future allocations. So depending on which platform your 401k is in or where you log in to see your account, that process could be a little bit different. But know that there's kind of two sides: changing what money you have currently and then changing where the new money is going to go. So I'll make a video. I'll do a follow-up to this email so everyone can know how to do that if you have questions. And I'll put it on our website and everything. So I know it's tricky, but hopefully that helps answer that question.
But if you're in the tier 1 target dates, you probably don't need to to take any action because that's going to do that on the fund level. And in the
Yeah.
tier 2 level, it's going to automatically rebalance in like next week at the end of quarter. So it's it's the self-directed mixes that need this rebalancing attention primarily.
Right. And then, so another question came in: how aggressive should my 401k be? I haven't previously had one, and I am 10 years from retirement. So, good question. Sam, do you want to touch on that? You want me to?
Yeah, I'd love to. Ultimately, I would like to have a deeper conversation about all the moving parts in your financial life. Thank you for the question. And that stereotypical answer, maybe not stereotypical, but kind of on average, a general answer for the typical person 10 years out from retirement is most often going to be in something like an 80-20 and looking to shift down to a 70-30 in the next few years. And then again, generally speaking, you want to give yourselves kind of 5-year time periods to have a good time to get more conservative. The longest historical time period you never would have had an opportunity to really sell high to move more conservative is you can kind of stretch it out to 5 years. So if you're 10 years out, maybe you'll be 80-20 right now for a couple of years. And once the market gets back up to kind of better levels than moving to a 70-30, would be kind of a general path to get there. Generally speaking, in retirement, if you're going to need this 401k assets to create income for you, you typically wouldn't want to be more aggressive than a 60-40, because a 60-40 is it's a great retirement ready portfolio, but more aggressive, and you start running into issues creating income through downturns in a more aggressive portfolio. So if you're just an average person, 80-20 might be a good position 10 years out, but you're looking within a few years to get more conservative and then more conservative again down to that 60-40.
Yeah, no, I think that's a great answer. I think it's kind of a puzzle to figure out, okay, in 10 years, let's back into the number. Let's figure out what are you going to need to fill that gap from whatever other income or savings you have, and include Social Security in that. What is that gap? And so we can narrow that gap down, and then we can know, all right, if we need to pull that out of this 401k, where do we need this number to be? And so we look at how much risk we can take over the period we have, as well as how much you could possibly contribute, and do it in a tax efficient way to create that where you get to that level where you can sustain retirement and have your needs covered. And if we do better in the market, great, we have a little bit extra, but at least we know that we're going to cover that piece. So it's an interesting puzzle to try and solve. And it's something that we do all the time and really enjoy figuring out. And actually, I've found most people just live in fear and have no confidence whatsoever that they can ever stop working. And if there's anything that we love more, is to give them that confidence back, to that all their hard work and effort they're putting in is actually something that's going to pay off one day, and give them peace of mind that they're doing the right steps and get there. Because there's no reason to live in fear that way, because I mean, most of us I think you're in a better spot than we really believe. We just don't know the steps to take to get there. And that's where our team comes in, and we really, I think, do a good job at helping clarify some of those things. And it's really fun when we get to that number and see someone change. So that's one of the best parts about what we do. So if you have concerns about that, I mean, you've got myself, Sam, Jared is up in Boise. We've got other advisors. Like, please reach out. That's really important that we help you feel confident in why you're even doing these accounts. So I hope that's been helpful. Let's see if there's no other. Hold on. Another question. What is the pros and cons of doing a Roth? Want to talk about Roths real quick?
Yeah, I'd love to. So Roths are a great tool. They can be a really powerful tool when used correctly. Really, the decision to use a Roth should be a decision whether to use pre-tax or Roth contributions. There's a misconception that is very common, that Roth money grows faster than pre-tax IRA or 401k money. And I could do some quick math to prove this, but in truth, the only thing that determines difference in kind of terminal dollars that you get to spend in your back pocket in retirement is the tax rate at which they're taxed. So with the pre-tax money, you don't pay tax now, you pay tax at the end. With Roth money, you pay tax now and you don't pay tax later. So really the only consideration that is material is, am I in a higher tax bracket now? Is my highest marginal rate now higher than my average rate will be in retirement? Because right now you're basically skimming off the top, and then all that money comes in and fills up your tax bracket in retirement. So is my average rate in retirement going to be higher or lower than my highest rate now? So for people early in life, early in their careers, Roth makes a ton of sense because they're only going to get higher and higher tax brackets. Whereas someone who's in the thick of their career and is in their highest earning years probably wants to be pre-tax, and they're probably going to have a lower average rate of tax in retirement. And so both pre-tax and Roth are powerful tools, and almost everyone will use them at different times in their lives. One additional option is what's called Roth conversions. So if you retire before age 72 when you need required minimum distributions, and especially before you take Social Security, there's some opportunities to pull money from your pre-tax IRAs and convert that to Roth while you're in a temporarily low tax bracket, because you've retired, you no longer have an income, you're living on after-tax wealth and other things. And so you can fill up those low tax brackets with Roth conversions. So there's lots of powerful things that can be done with Roth, but I think the most basic thing that almost everyone deals with is, what do I do, pre-tax or Roth right now? And it's really just a question of, is my highest rate higher than my average rate will be in retirement? And if it's higher, then you want to do pre-tax. If it's lower or the same, you want to contribute Roth.
Yeah, there's a lot that can be said of Roth and traditional. I think most people probably could benefit more from traditional that are doing Roth, but it's been used, and it can be used really well. And I think the fear, honestly, that drives that whole thing is people think that tax rates are going to go double, right? This fear that the government's going to change taxes to this massive, crazy level is really not backed by much truth. We see all this spending and the stimulus. I mean, that doesn't help with that fear, but there's a certain point and there's certain ways that the government, if they do that, they're going to find other ways that are created from a tax strategy to keep your taxes in a sustainable level, because they need to maximize their revenue. I mean, the government is trying to make tax money to do the things they want to do. If they go too far, it disincentivizes you to even work. So there's a real fine balance with taxes, and it's an interesting topic that you could spend hours on. But knowing the tax rates you're in, most people don't even understand that bracket system, is really important. So if you haven't ever had that conversation with your accountant or your CPA or whoever's doing your taxes, figure it out. Like, as this is tax season right now, like, find out, where am I? Like, the last dollars I earn, what am I taxed at? If it's in the highest bracket or in the 30%, up in that range, you might, and you're doing Roth, you might want to rethink that. So start there. Start that by knowing what your current situation is and what taxes you are actually paying. And then we can kind of have a conversation around which one you should pick. So, because there's no difference in the 401k fees or anything like that. It's purely a tax play. So your money is going to be matched the same, whether it's Roth or not. That's a common misconception. If you do Roth, you're still going to get a traditional match from your employer. And so you'll eventually have an IRA of a Roth IRA and a traditional IRA in retirement when you roll that money out. So that topic can go on and on. Hopefully that answers your question. Let me know if it doesn't. We can dive in more off the webinar. But other questions? Anybody else? These are good. Keep them coming. We love this stuff. As you can tell, we could talk about this all day long. Anything else you want to add, Sam? I don't see any other questions coming in.
No, I think that's it. I just say that it's a really uncertain time right now, but stick with your long-term strategy and you're going to be successful. It's the quick herky-jerky adjustments in times like this that cause people long-term problems and poor long-term outcomes. So stay with your long-term strategy and don't panic, and everything's going to be okay.
And realize that the media, the news, their number one goal is to get your attention, to sell more advertising, to increase their revenue. It's not necessarily thinking about what's best for you and your 401k. And so one of the things I love about our office is we don't even have CNBC on the TV like every other financial firm. We watch the news really closely, but typically if you're reacting to news on like CNBC, for example, it's too late. I mean, the big institutional trades have already been done. You're going to probably be on the wrong side of that decision. So be smart about what news you're taking in and how you're reacting to it. there's a lot of it out there, and a lot of it can drive emotions that cause you to do things that are irrational. And we spend a lot of our means just talking through some of those things, those things you think about, and it might be a good move. So don't let the news scare you is the main point. They're loving it right now. They're getting huge ratings because of this bad news, and they're going to keep pushing it as hard as they can. So just be cautious of that. Other than that, I think, one more question. Can a person open 2 401ks with different payouts? I'm not sure exactly what the payouts. So you can definitely have 2 401ks. If you have, for example, you're an employee of a company, you're getting a W-2 check from an employer, and you're eligible for their 401k, you can contribute to that. You could also, if you had your own LLC, say you had a side hustle or side business, and you also had income there, you could do a 401k there. There are annual limits that the total can't go over at $57,000 a year. So there's some math behind what you can and can't do, but it really depends on if you're, and this is on the contributing side. I'm not sure if your question meant 80-20 or 7-30. Maybe your question was more about pulling from. Yes, you can have multiple 401ks. So let's say I think your question was if you have old 401ks and you now have a current one, not so much on contributing. Yes, you can keep multiple 401ks. A lot of times it makes sense to roll them over to an IRA or to your current 401k just to keep fees down. The IRA is typically going to be less cost because there's less administration behind it. But there's a lot of scenarios that go into that, but you can essentially create 2 portfolios within one plan anyway. It's kind of confusing to do that, but it's possible. But eventually the path you kind of take as you're contributing your 401k over your career, and you switch jobs, and you have, let's say you have 3 or 4 of them out there. You've got one at Fidelity, one at Mass Mutual. They're all over the place. The most common path we see is we roll those all into one IRA account. So there's not a taxable event. And, I just lost all my lights. And you roll those into an IRA, and then you start to pull money out of that down the road at a strategic time from a tax side of things. So keeping open all these 401ks doesn't necessarily give you any advantage. Hope that answers your question. Okay. Anyone else? Okay. All right. Well, thank you, everybody. We'll wrap it up. Again, you can reach us. You can respond to the email that went out, jake@truenorthretire.com. You can call or text me. My number is 385-204-4015. We'll send a follow-up email with all that and a link to my calendar as well to create a Zoom meeting, because you're stuck at home and we don't want to go against what we're doing is keeping everyone quarantined. So let's keep in touch though, as questions come up, as you get concerned. We'll also repost this video on our blog so you can share it with others, but please reach out if you have questions or concerns. Anything else, Sam?
Nope, we're good. Good luck out there, everyone. Stay healthy and safe.
Okay. Thank you.